Hello, and welcome to AWCI's webinar focusing on the economy. This webinar is sponsored by the Foundation of the Wall and Ceiling Industry. I am Anne-Marie Salvatelli, Director of Education and Member Services at AWCI. Our presenter is Dr. Anirban Basu. Dr. Basu is Chairman and CEO of Sage Policy Group Incorporated, a Baltimore-based economic and policy consultancy he founded in 2004. Dr. Basu earned his Bachelor of Science in Foreign Service at Georgetown University. He earned his Master's in Public Policy from Harvard University's John F. Kennedy School of Government and his Master's in Economics from the University of Maryland, College Park. He acquired his Juris Doctor at the University of Maryland School of Law and completed his doctoral work at UMBC with a concentration in health economics. He has lectured at several universities, including Johns Hopkins University and Goucher College. So with this, welcome, Dr. Basu.
Righto, Anne-Marie, and thank you, of course, to our sponsors, the Foundation of the Wall and Ceiling Industry. My name is Anirban Basu. I'm an economist. Please hold any further applause. And this is the opportunity to talk about the economy, where we are in the business cycle. We'll talk about all manner of things, vacancy rates and interest rates, cap rates, etc., mortgage rates. So let's get to it. My presentation today is entitled, as it turns out, First Brood. It's a play on a 1982 film called First Blood, starring Sylvester Stallone. This is the movie that introduced the character of John Rambo. Ultimately, there'd be 5 Rambo films. The last one showing up in 2019 called Last Blood, a fitting tribute to an excellent series. This is a Stallone-themed presentation. Now, the word brood has multiple meanings. The one I'm using is to think about something deeply that makes one unhappy. And what we're thinking about today is the economy. And it makes a lot of people unhappy, not everyone. And one of the things I want to do today is distinguish those who are delighted with the economy from those who aren't. But there's a fair amount of angst out there. In fact, dare I say, there's a fair amount of dread. Lousy film here, 1995's Judge Dredd, 136, or I should say an hour and 36 minutes of pure mediocrity. I've also respelled dread from the movie spelling of D-R-E-D-D to D-R-E-A-D to be clever, but not an excellent film, not his finest moment as an actor. In any case, there is a fair amount of dread out there, but I can't just simply say that. I've got to demonstrate these things to you. It's not enough for me to make a statement as an economist and just leave it at that and expect you to simply believe it because, well, I have control of the webinar. That's not right. And so let me show you, for instance, some data. This is the University of Michigan's Index of Consumer Sentiment. Michigan, of course, winning the NCAA Men's Basketball Championship as the #1 seed, but this is their survey work. And it's also exquisite and excellent and very much followed by the markets and other observers. And you'll notice here that sentiment is really low. In fact, it's below where it was during the global financial crisis. Now, unemployment in the US is not higher than it was during the global financial crisis. In fact, it's much lower at 4.3%. Stock market is booming today. You got a Dow Jones above 50,000. You got a S&P above 7,500. I mean, they're at record highs. And yet there is this pessimism that pervades the American public. And of course, there are political implications there as well, as this is a year of midterm elections. So this is maybe a warning sign for certain incumbents. We'll see. But the point is, where is all this angst coming from? Because it's not coming from unemployment. It's not coming from the stock market. Where is it coming from? Obviously, it's coming from high and rising prices. Now, we received some data on inflation earlier this week, consumer price index data, producer price index data. Yesterday, the inflation data have come in red hot. And if you looked at the producer price index, which is a measure of wholesale inflation, on a year-over-year basis, based on yesterday's data, that's up 6%. Consumer prices also are high and rising. You can see that here. So here I'm showing you consumer price index data, and I'm taking you back to May of 2020. Why May of 2020? No, it's not arbitrary, as it turns out. May of 2020 is the first month of the current economic expansion. So America loses 22 million jobs in March and April of 2020. We start to add back jobs in May of 2020. You might remember back in relatively early April of 2020, governors like Brian Kemp of Georgia and Ron DeSantis of Florida began reopening their economies. Not saying that was good policymaking or bad, by the way, that's for you to decide. But it did position those and similarly situated states to begin adding jobs around that time. And by May of 2020, the overall nation's adding jobs, and the official end date of the previous recession was April 2020. So if you go back to May of 2020 and look at prices as they were back then and compare those prices to April of 2026 prices, which is the last month which we have these data, and again, the April data came out earlier this week, these horizontal bars represent how much prices have changed. So you can see here, if you look at the blue color bars down below, that's where the headline numbers are summarized, how much inflation America experienced in not quite 6 years in a country that aspires to 2% inflation per annum. For after all, the Federal Reserve's target for inflation is 2%, but various measures of inflation indicate that inflation is running much closer to 3%, and in some instances above 3% recently. So how much inflation did we suffer in 6 years? 29.9%, let's call it 30%. Strip out food and energy prices, you get that so-called core rate inflation, with which we economists are fixated, or upon which we are fixated, 26%. Now, categorically in green, energy prices up 81.1%. Transportation services, that's your shipping costs, 57%, and that affects contractors, of course, because among other things, construction materials, whether lumber or other materials, gypsum, whatever it happens to be, drywall has to be shipped to job sites. Shelter costs of 31%, food prices of 30%. And so these rising prices have a lot of Americans in a really foul mood. Now, there are more implications to this inflation. So all things being equal, the higher is inflation, the higher are interest rates. So this is a pivotal interest rate in the US economy. I'll show you the Canadian version in just a moment. Next slide. But this is the federal funds rate. This is a policy instrument utilized by the Federal Reserve Bank of the United States. It's a principal mechanism by which to influence economic growth, and it's byproduct of inflation. When this rate is set at a low level, it stimulates more lending in the economy and therefore more spending in the economy. When this rate is set at a higher level, it frustrates borrowing and spending activity. Now, what's being graphed for you here is the upper limit on the federal funds rate. So the minimum possible here is 0.25%. Now, coming into the pandemic, so now we're in late 2019, this rate is sitting at 1.75%. But predictably, as the pandemic undoes the economy, this rate is pushed as close to zero as was possible, 0.25%. Now, the economy begins to recover during the summer of 2020, but it's not until roughly March of 2021 that inflation explodes. Those price pressures really manifest themselves. All that fiscal stimulus, all that monetary stimulus. So demand is surging for goods and services. Supply chain can't handle it. Prices take off. But in 2021 itself, the Federal Reserve does nothing about that inflation. They view that inflation to be transitory. A synonym for transitory is fleeting. They think it's purely supply chain driven, that as supply chains normalize post-pandemic, inflation will just naturally and automatically abate to that 2% level we'd enjoyed for many years prior to the pandemic. They're dead wrong. Team Transitory misses it completely. Instead, they preside over the creation of a wage price spiral. So, among other things, workers notice prices are rising. Boss, I need a raise. I cannot afford my life. Boss says, no problem, I'll give you a raise. I need you. Economies coming very, very quickly. There's lots of unmet demand out there. I'll just pass on my cost increases to my customers and clients. Wage price spiral. Now, after about a year of this, the Federal Reserve begins to raise interest rates. It begins March 16th of 2022. And between March 16th of 2022 and July 26th of 2023, they raised this interest rate from 0.25% to 5.5%. Not good for construction, including residential construction. Of course, mortgage rates take off. We'll talk about that in a moment. The Federal Open Market Committee that sets these interest rates meets 8 times a year. And for 8 consecutive meetings, they do nothing on rates, neither increasing nor decreasing them. That's that flat spot that you see toward the northeast corner of the slide. Now, inflation does abate. It peaks at over 9% in mid-2022, but it starts to fall. And by late 2024, the Federal Reserve starts to actually cut interest rates. September 18th, half percentage point rate cut. November 7th of that year, quarter point rate cut. December 18th, quarter point rate cut. Now we're down to 4.5%. The expectation is that in 2025, we'll get even more rate cuts as inflation falls further and actually gets down to that 2% target. Nope, doesn't happen. That, of course, is the year of, among other things, tariffs, whether the 50% tariffs on steel, aluminum, copper, 45% tariff on Canadian softwood lumber, or the Liberation Day tariffs. That puts upward pressure on prices. Federal Reserve is on hold until when? September of last year, quarter point rate cut, October, quarter point rate cut, December, quarter point rate cut. Now we're down to 3.75%. But the point of this slide is pretty obvious. Interest rates are still quite high relative to where they had been pre-pandemic and relative to what one might consider a neutral rate. And again, with inflation bouncing higher recently, it suggests the Federal Reserve is not in a position to cut interest rates anytime soon. But this is part of a broader North American phenomenon because the Central Bank of Canada, or the Bank of Canada, same issues here. So you notice your same trajectory. Now, even though I put the Bank of Canada second in this two-slide sequence, please note that the Bank of Canada began raising rates before the Federal Reserve did, and they began cutting rates before the Federal Reserve did. So they've been a prime mover, first mover. And I think better policymakers, frankly, than the Federal Reserve policymakers. Nonetheless, the end point is the same here. Interest rates are still high enough to suppress certain types of economic activity, including, of course, home buying and home building. And again, we'll talk about more of that when we get later on in the presentation. But here's the good news. Despite the headwinds of these higher borrowing costs, there's still parts of the economy that are performing quite nicely. And we'll turn to those parts of the economy now in the next section of the presentation entitled Over the Top. This is a 1987 Stallone film, one of his finest works. And the subject of this film is arm wrestling. And you might be surprised to learn as an audience that relatively few movies have been made about arm wrestling. It's relatively a niche genre, but if you know this film, and you should because it's an amazing film, it's not so much about arm wrestling. It's really about the love of a father for his son, and as the plot unfolds, the love of a son for his father. And of course, it's 1987. So if you're nostalgic for the 1980s and you love arm wrestling, I would recommend this film highly to you. I think you'll find relatively few substitutes. Now, if you're going to talk about parts of the economy that are performing well, I think it's pretty obvious where you begin. It's obvious. You begin with artificial intelligence. And there are a number of physical manifestations of AI. One of them, of course, is computer chips, helping to explain why NVIDIA has become the first company in the history of the planet to reach a $5 trillion market capitalization. If that were annual national GDP, that would be the fourth largest economy in the world. And that's just one US company, NVIDIA. And you may have heard that another company at the vanguard of artificial intelligence, Alphabet/Google, is about to surpass NVIDIA in terms of market capitalization. Indeed, what I have here is the annual capital expenditures generated by the so-called hyperscalers, Alphabet and Amazon on the left, Meta and Microsoft on the right. When does this process, this super cycle in AI investment begin? When does that process begin? November of 2022. Why that month? That is the month that OpenAI launches ChatGPT. And these hyperscalers, among others, realized immediately how monetizable this is. This is beyond search. This is educating the young. It's co-piloting firms. It's all kinds of use cases we can scarcely imagine. But it's, at the end of the day, a technological revolution. And these firms are seeking to dominate that revolution. They want to be at the commanding heights of artificial intelligence, but they need to build data centers to do that. They need storage. They need compute capacity. And so you can see by 2025 how profound the expenditures got. So in the aggregate, these companies spent around $400 billion in 2025 on AI infrastructure and architecture. The estimate this year is they'll spend around $700 to $725 billion. Now, their expenditures are somebody else's revenues. So with all of that money sloshing through the US corporate sector, it's no surprise the stock market is booming. Corporate profits are forecasted at record highs. Another implication, of course, is the fact that data centers use a ton of electricity. So when you look at private construction spending on electric power generation distribution, you're going to see another leg up in this data series. You see a big increase in spending in this category in 2023. Government policy matters. In August of 2022, President Biden signs, among other things, the Inflation Reduction Act, which is largely an alternative energy generation act to stimulate alternative energy generation and related manufacturing activity, as it turns out. And so you see that big jump. The next wave, of course, probably more fossil fuel and nuclear power dominated. But the point is, you're going to see a lot of investment in these categories. Say, Anirban, why hasn't it happened already? It's happening. A lot of these projects are in development phases. It takes a long time to get a major electric or electric power generation or distribution project to be financed, or of course, to pull permits. It takes approval, and that's difficult, especially if local governments get involved. But the point is, you're going to see another leg up in this data series. And so between data centers and electric power generation distribution, these tend to be the strongest segments of the construction economy going forward. But again, there are other implications. So again, corporate earnings are forecast at record highs, in part because the hyperscalers are pouring so much money into the economy and into the corporate space. And so that has helped to foment a boom in stock prices. So these data relate to the S&P 500, which again, today, for the first time, reached 7,500. It's just sitting a little bit below that right now, right around 7,499, 7,500, right as I'm speaking to you. But the point is incredible. So now you can break down the S&P 500 in a number of different ways. The way I've done it here is as follows. You see the green line? That represents the Magnificent Seven, and we know who they are. Apple, Amazon, Alphabet, Meta, Microsoft, Nvidia, Tesla. And these are some of the companies that are most closely wedded to the artificial intelligence revolution. And what the green line is depicting is the percentage change in closing share price since January of 2024. So basically looking at the last 2 years plus of share price increases, and look at that, Mag 7 returning more than 70% in a couple of years. Now, the blue line represents the balance of the S&P 500, so that's your other 493 companies. We don't call them the Magnificent 493, but I think we can agree that many of these companies are in fact magnificent. I think we can agree that Eli Lilly is an amazing company, and so is Walt Disney. I think we can agree that Caterpillar and John Deere and other companies are amazing companies, Marriott, JP Morgan Chase, whatever you want to think of, a lot of incredible companies. By the way, the TSX, the Toronto Stock Exchange, also booming to the upside recently. So again, this is part of a North American phenomenon, and there's a wealth effect. So when share prices increase, that causes people to become wealthier, at least on paper, and so they spend more money in the economy. You might point out to me, but Anirban, not everyone owns stock. You're right about that. 40% of Americans own no stock. They don't have a 401k. They don't have a 403b. They don't have a Vanguard, Fidelity, or T. Rowe Price account. But for the roughly 60% of families that have a portfolio that includes U.S. equities, they're getting wealthier. They're spending more money. Now, you can see the effect of this in the next slide, in which I break down the U.S. population into 5 distinct quintiles. And these quintiles are distinguished by household income, and I should say aggregate spending, right? So the green line, for instance, represents the top 20% of income earners, top 20% income earners in the United States. Your 81st percentile to your 100th percentile, your top 20%. And what the green line actually depicts is their household or aggregate spending. You see a kink in that line? That's the pandemic. And then you see an explosion to the upside in their spending, their standard of living. Well, of course, this is a group that owns the most stock. They own the most residential real estate. And a lot of that real estate, of course, is appreciating value over the course of time. So they've really benefited from the appreciation of asset prices. The yellow line there is your second quintile, your 61st percentile to your 80th percentile. You can see a nice move to the upside in their spending, but it's not nearly as dramatic. Well, of course, they don't own as much stock. They don't own as much real estate. The light blue line is your third quintile, your 41st percentile to your 60th percentile. And now you can see the spending growth is even more modest. So as you come down the income ladder, the spending growth becomes more modest. The dark blue or black line down below that is your fourth quintile, your 21st percentile to your 40th percentile. And now the spending growth is actually quite modest, isn't it? And a lot of that is not because households in this quintile are buying more goods and services. No, they're spending more on the goods and services they're buying. So I think many Americans would agree, this is probably true for Canadians as well, I suspect, that 2 months ago they're spending less on gasoline than they are today. It's not because they're buying more gasoline. It's not because they're driving more. They're paying more for what they're buying. So some of this inflation is induced because food has become more expensive and they have to eat. Now, at the very bottom in purple is your fifth quintile, your lowest income earners. I put that in purple to signify the Baltimore Ravens, the most disappointing team in the NFL this year. And now you can see the spending growth is even more modest. And people know about this K-shaped economy in which people on the line that's going up off that vertical segment of the K, the people who are already upwardly mobile are even more so now because their stock portfolios have never been thicker. They have massive amounts of wealth compared to where they had been, let's say, 6 or 7 years ago. But those who are on the line that slants to the bottom, that's a negative slope, they're being eaten up by inflation. And so living standards are not improving. In fact, I think many of those folks would say that we're in recession, and they base that on their personal experience. My living standards are fading because I can't afford rent, I can't afford food, and so on and so forth. Now, how does this all add up macroeconomically? Typically, an economist would begin a presentation by talking about the big picture statistics, gross domestic product, for instance. But I've given you data regarding certain slices of the economy, spending by quintile, stock market performance, spending by hyperscalers. But how does this look from a big picture perspective? Let's turn to that now in the next part of the presentation entitled The Spendables. Now, this is a play on a 2010 film called The Expendables. Again, not a good film, though it ought to have been. For its a star-studded cast, it of course stars Stallone, but also Jason Statham is in this film, Terry Crews is in this film, Dolph Lundgren is in this film, Arnold Schwarzenegger is in this film. So it's a star-studded cast, but at some point for a movie to be compelling, it has to have some semblance of a plot. There has to be some story that's being told, and this lacks that. It can't just be pure machine gun fire and occasional knife play. There has to be more than that, but maybe I am missing the point because they made this movie 4 times. Now, let's start with the big picture statistics, and let's turn back to our friends, the consumers. You might ask the question, Anirban, this is a construction audience, why are you spending so much time on the consumer? Well, of course, the consumer is 2/3 of the economy. You cannot have an economic downturn unless the consumer participates. And based on retail sales data, thus far the consumer is not participating. Monthly retail sales. Last 2 months here are February and March of 2026. Actually, this morning, we received April retail sales data. They were quite strong. Consumer spending, and by the way, much of the growth in consumer spending or household spending is on services, things like travel. So if you look at TSA checkpoint counts in the United States, despite the fact that the Canadians are visiting us less often in the United States, it is still the case that TSA checkpoint counts are higher now than they were a year ago. And a year ago, they were higher than they were in 2024. And 2024 was a good year for US travel. And so, they're spending, right? They're spending on Beyonce concert tickets, they're spending on Taylor Swift concert tickets, so on and so forth. So, Ice Spice, whatever. The point is they're spending. And when the consumer's spending, that's going to inure to the benefit of gross domestic product, quarterly data, annualized rates of growth. So the last quarter for which we have data is the first quarter of 2026. It's the quarter in which the US economy spent at 2% on an annualized basis. No hint of recession there. Last year, the US economy grows 2.1%. That's pretty good, especially by advanced world standards. We don't yet have second quarter data, of course. We're immersed in the second quarter right now. So we don't have data yet from the Bureau of Economic Analysis, but we do have an estimate of second quarter GDP from the Atlanta Federal Reserve's GDP Now model, indicating that during the current quarter, the US economy is on pace to grow 3.7% on an annualized basis. Booming stock market, strong national output growth. Again, how does one reconcile this with an utterly pessimistic American household? Or that University of Michigan Consumer Sentiment Survey at a record low. How do we reconcile that? Well, we talk about inflation, of course. But something else to note about the data is that job growth has become more erratic. This is monthly job growth in the US. It's that headline number that typically shows up the first Friday of every month. Not always. There's occasionally the federal government is shut down, so we don't get a release then. And occasionally, as was the case this month, that first Friday shows up on the first of the month. And so these data were not released for April until May 8th, as it turns out. But we now have the April data. And in April, the United States has 115,000 jobs. Not bad. It beat consensus expectations by a good bit. In March, 185,000 jobs. So the last 2 months, precisely 300,000 jobs. Now, I should point out to you, of course, that you've got to take all data with a grain of salt, all data, including data I present to you. You've got to be skeptical. You should be. And one of the reasons for skepticism in this instance is that these data are subject to revision. So let me give you a sense of how powerful these revisions can be. Back in January of 2025, so a bit more than a year ago, we got an estimate from the Bureau of Statistics that the US added 143,000 jobs. Oh, pretty good, 143,000 jobs. But that number has since been revised lower to a negative 48,000. And you can see before the last couple of months how erratic job creation had become. One of the things that we note about the US labor market is that hiring has really softened. This is US job openings. This is from the JOLTS, the Job Openings Labor Turnover Survey. You can see job openings have really fallen, actually now below where they had been pre-pandemic, at least certain times during the pre-pandemic period. And so hiring has really softened. There was an article yesterday in the Washington Post. If you read the Washington Post, you may have seen it, about why this is the worst job market for recent college graduates in recent memory. Number of reasons, multi-factor reasons. AI is one of them, as it turns out, but there are others. Now you say, Anirban, this is a construction audience. I mean, do you have data on US construction job openings? Because that would be awesome. Yeah, I got it. And you can see also that construction job openings are much lower than they had been several years ago. It doesn't mean that you're still able to find the workers you want. I mean, you're looking for certain skill sets and reliability, and that might be in short supply. But job openings, actually, advertised job openings have fallen in construction. And I have to tell you, this surprised me. And you know why it surprised me? Because I was thinking that there would be a big increase in job openings, construction job openings, but it didn't happen. But why did I think that? Because immigration policy has changed. And I don't want to get into a debate about immigration policy. I don't. I mean, I'm a big fan of immigration. Look at me, if you can see my face, right? It's written on my face, big fan of immigration. I could write on my forehead, it would be redundant. But, look, I also understand, by the way, that the southern border is an issue. But 25% of our construction workforce in this country is foreign born. And of course, as you know, in certain places like Texas and California, it's much more than 25%. So obviously, with there being less documented migration to the United States, and with many people self-deporting or engaged in ICE actions, that worker, especially the undocumented worker, is not as available to contractors. And again, I understand the southern border is an issue because one of the things I do a lot of is I watch a ton of Fox News. I watch a ton of Fox News. And I watch Fox News because my mom makes me. So I live 4.5 miles away from my parents in Baltimore County, Maryland. And I'm with my parents a lot as a result of that. And when I'm with my mom, she tends to be near the kitchen. She's got a very nice TV there, and she watches Fox News all day, every day, without exception. So if I'm with my mom, I'm with Fox News. So I get it. But I was expecting to see a real surge in construction job openings as contractors look for documented workers or native-born workers. You didn't see that. You don't see that in the data. And I'll get to why that is later in the presentation when I talk about the U.S. construction spending data. Now, unemployment rates. I promised you Canadian data. Here are some. Canadian unemployment rate here in yellow, U.S. unemployment rate in green. You can see it's been trending higher in both nations, a bit more strongly to the upside in Canada than the United States, but still it's been rising. And so the simultaneity of a weaker job market, rising prices, has many Americans, and perhaps some Canadians, somewhat pessimistic about or dour about the economic prospects in front of them. This is unemployment rate by Canadian province. So Ontario is approximately 40% of the Canadian economy. It's one of the most productive, dynamic economies in the world, one of the largest economies in the world. It's a juggernaut by global standards. Ontario unemployment rate is now 7.5%. It's pretty high, right? Prince Edward Island, 8%. And you see some of this, by the way, in the United States as well. So when you look at the unemployment rates for the 25 largest or most populous metro areas in the country, look at the bottom of the right-hand column here. Now, these data are only for February. The federal government is still catching up in its data releases from the federal government shutdowns. But you can see, if you look for the bottom of the right-hand column here, you got 6 markets here with unemployment rates above 5%. And look, a 5.7% unemployment rate in Seattle Metro is not cataclysmic. Don't mean to make a mountain out of a molehill, but these rates of unemployment are higher than they were. And so again, you might remember 3 or 4 years ago, this phenomenon in which Americans were jumping from job to job, lots of job switching, often chasing the highest wage they could get and then going to the next job with a higher wage. And what did we say about those folks back then? We said, well, they're disloyal. And maybe that's right. Maybe that's exactly how one should characterize them. But in hindsight, what might we also say? That the prices were rising so quickly back then, they had to move to that next job with that higher wage simply to maintain their living standards. But right now, at least in certain parts of the country, they may not have that next job to move to, but they're still face high and rising prices. So what have I said so far? What I've said so far is this: Silicon Valley is fine. Artificial intelligence boom is pumping money through the veins of the Silicon Valley economy, and also Austin, Texas, Research Triangle, epicenters of AI development. Wall Street is fine, right? We see more merger and acquisition activity. I don't know if you see the traders at Jane Street Capital. Their bonuses just simply massive. And of course, we've got all these initial public offerings in front of us, including today a chip manufacturer named Cerebras. But then, of course, we've got three massive initial public offerings in front of us: SpaceX, Anthropic, and OpenAI. So the investment bankers, Wall Street, are busy. Silicon Valley is fine. Wall Street is fine. What I'm trying to say, though, is the parts of the Main Street economy, are a little rocky. Now, this is his finest work. The first Rocky comes out in 1976. So the movie turns 50 years old this year. He turns 80 years old this year, born July 6th of 1946. Ultimately, there'd be 6 Rocky films, Rockies 1 through 5. The 6th film is called Rocky Balboa. It comes out in 2006, and it features Stallone as an aging boxer now in his 50s. Of course, he turns 60 that year. And he's got one good fight left in him. He ends up fighting the then heavyweight champion of the world, Mason Lion Dixon. And it's, again, a fitting tribute to a wonderful series. Now, if you include the Creed films, 3 Creed films, there are 9 films in the Rocky series. But I got to tell you, like restaurants or marriages, first time was the best. And so Rocky 1, I think, really set the standard for this series. Though I must say, Rocky 4 is also quite compelling. That's a film that stars the aforementioned Dolph Lundgren as a Soviet boxer. That movie shows up in November of 1985. Now, let me sequentially walk through parts of the economy that are a little rocky, and this is also the part of the presentation in which I will introduce construction-relevant data. So these are loan delinquencies, consumer loan delinquencies. Green line is credit card delinquency. It's rising, and it's been rising before gasoline prices took off. And by the way, this inflation is sticky. Why? Because farmers right now in the US and also in Canada are spending around 2x what they had been spending on fertilizer before the conflict in the Middle East began. And so that's going to show up in food prices in 6, 7, 8 months, etc. So this inflation is going to bedevil the US and Canadian consumers for quite some time. Now, the blue line is student loan delinquency. And as you know, that one of the things that the Trump administration did last year was it altered rules regarding student loan repayment. One now has to repay these loans. Now, that's standard operating procedure, as it turns out. If you borrow money, you're supposed to pay it back, but it caught a lot of people by surprise. And now they're delinquent. And this also impacts their credit scores negatively, which further impedes their access to credit and therefore their spending power. Rocky 2. Now, we talked about that wealth effect, right? And part of that is the appreciation of real estate, including residential real estate. But if you look at the S&P Case-Shiller Home Price Index, just the 1% change, just the last data point that we have is February of 2026. If you look for the bottom of this slide, these green color bars, you now observe a number of markets where home sales prices are falling, including some prominent southern markets like a Charlotte, a Phoenix, a Dallas. Why? Well, those markets in particular are oriented toward a certain amount of expected in-migration. We expect a certain amount of people to move from, let's say, California to a Phoenix or a Dallas, etc. I just spoke in Fayetteville, Arkansas last week. Lots of Californians now live in Northwest Arkansas. That's Bentonville, Fayetteville, University of Arkansas is there, Walmart headquarters is there, so on and so forth. There's a lot going on in Northwest Arkansas. But the point is, Californians are moving. But Americans overall are not moving as frequently as they once were. So this is the percentage of US population that moved in the past year. And I got to tell you, this affects people in this audience. Because America's actually at her best when she's moving around, when people are taking their best job opportunity, but they're not moving right now. They move for a couple of reasons, by the way. One, of course, is they get that better job. So they've been working in Baltimore, they get a better job in Austin, they move to Texas. But right now, we're not adding as many jobs. Last 2 months of data notwithstanding, job growth has softened. And so more Americans are staying home. The magnetic pull of job creation is less than it often is. And of course, the tail wags the dog in another way. A lot of Americans refinanced those ultra low mortgages during the pandemic and initial stage of recovery therefrom. and they're not going anywhere. If you're sitting in Duluth, Minnesota, or Kankakee, Illinois, with a 2.75% 30-year fix, where are you going? Not going anywhere. You might want to move. You liked that house when you bought it. It was fresh to you then. It was new to you then. You liked your neighbors, then you met them. But now you want to move. But you can't move because your next mortgage rate is 6.37% on a 30-year fix. So you just stay where you are. And for the southern markets, like Phoenix and Charlotte, so on and so forth, with people not moving around as much, the inventory of unsold homes goes up, and that puts downward pressure on home sales prices because, of course, homes take longer to sell when people are not moving in as large numbers to a particular community with homes available for purchase. Now, this also affects construction. Oh, these are important slides for this audience, I suspect. The green line there is housing started and construction. It's plummeted. Everyone seems to agree we have a housing shortage in this country. Everyone. People disagree about whether it's 3 million units or 4 million units, but everyone seems to agree we don't have enough housing in this country, and housing is too expensive as a result of that. But projects are not penciling out from a pro forma perspective. Interest rates are stubbornly high, in part because inflation is stubbornly high. And so project financing costs are high. Materials prices have been rising. More data on that in a moment. And of course, workers have become more expensive. In much of the economy, wage growth has slowed recently, but not in construction. Their wage growth has accelerated. And the buyer is constrained in terms of how much they can spend, the would-be buyer, because mortgage rates are high. So you put it all together, deals not penciling out from a pro forma perspective. You see that in multifamily and single family. Now, the blue line is employment among residential building contractors. That's flat. So we don't see a lot of layoffs in this category because, of course, it was so hard to find these employees in the first place that contractors are loath to let them go, even though there's some evidence of burgeoning idleness here. Now, the leading indicators are not much better. I'm going to show you a number of leading economic indicators as I march toward the end of this presentation. So here they are. Here's a couple. Well, let me actually touch on this first before I go to those. So this is Rocky 3. So I know there's been a lot of chit chat in the last couple of years about return to work. So, for instance, early last year, Jamie Dimon, the CEO at JP Morgan, probably the most powerful person on Wall Street, said, "Hey, you want a job at JP Morgan? You best come to the office 5 days a week." And indeed, 54% of those who work for the Fortune 100 in this country are back in the office full time, meaning 5 days a week in person in the office. But it is still the case that that remote work is more pervasive than it used to be. It's still the case that remote work is more pervasive, more common than it used to be. And so one of the aspects of life is that vacancy rates are still stubbornly high. These data come from CB Richard Ellis, CBRE, and characterize the fourth quarter of 2025. Now, these are citywide office vacancy rates. San Francisco has a massive office market. It's huge. It's 33% vacant. Seattle, you see the Seattle skyline, it is glorious, as is their defense, 29% vacant. Chicago, 29% vacant. Denver, 28% vacant. Dallas, Portland, 27% vacant, so on and so forth. So, we of course care about the building owners. We care about them deeply because many of them are our customers and clients. But macroeconomically, we also care about the banks and their exposure to these dynamics. So let me give you an example of what's been happening in America. About a year ago now, the Wall Street Journal penned an article featuring downtown St. Louis. Now, St. Louis, of course, is a beautiful, historic American city. And the tallest building in downtown St. Louis is the 44-story AT&T building. In 2006, that building sells for $205 million. It just sold for $3.5 million. Now, somebody takes that loss. It could be a series of equity holders in that building who chase that valuation downward from purchase to purchase. Of course, that could be some banks' collateral. And we do see more write-downs. We see more foreclosure activity. And this makes it less likely that an individual banker will lend aggressively into the commercial real estate space because the industry is taking some losses right now. It's not great for banking reputations. Now, again, not to make a mountain of a molehill, I've yet to observe one major U.S. financial institution falter because of their exposure to commercial real estate. Nonetheless, there is this headwind out there in the form of these high office vacancy rates. And one of the things that many office building owners tell me is that my bank is not even willing to give me money for TI, meaning tenant improvement, because they want me to spend whatever cash flow I have paying down their existing or pre-existing debt that they are lending to me. So they're not giving me money for TI, and of course, well, that could limit construction activity as well. Rocky 4. Now, there are further implications to this. As a general proposition, cities are more commercial real estate in nature, suburbs more residential. You might be able to find an exception someplace, right? I mean, if you look at Georgetown, the residential neighborhood in Washington, D.C., that's more residential than, let's say, parts of Arlington or Roslyn, Virginia. Okay, so, but in general, as a general proposition, cities are more commercial in nature, suburbs more residential in nature. And with many commercial buildings losing value, including for tax assessment purposes, no surprise that many cities find themselves in fiscal distress. So let me take these bullets in turn. With the city facing a projected $1.12 billion shortfall in 2026, Chicago Mayor Brandon Johnson said recently, quote, "We have reached a point of no return." That's ominous. Chicago is a big city. And they're not alone, by the way. Between December of 2024 and April of 2025, Chicago, LA, San Francisco, and Washington, D.C. all experienced credit rating downgrades, as did my state of Maryland for the first time in 52 years. Moody's downgraded us last year from AAA to AA1. So cities and some states are now facing some fiscal stress, and this can affect the construction of fire stations, police stations, schools, so on and so forth, infrastructure generally. And finally, according to research conducted by the Pew Charitable Trust, at least 20 of the nation's 25 most populous cities have reported budget cuts for fiscal year 2026 and often beyond. So one of the implications of this is infrastructure. Now, back in November of 2021, President Biden signed the Infrastructure Investment and Jobs Act, that $1.2 trillion package. Authorization for the act ends September 30th of this year. So the money has to be obligated by that date, September 30th of 2026. But the spending can continue. So those monies probably linger through the economy into the 2030s, as it turns out. But we will need to see reauthorization this year of infrastructure from the Trump administration, and we don't know what they're going to do. But one of the things that Trump administration officials have said is that we think that states and cities should take on more responsibility for infrastructure financing. I'm not saying that's right or wrong. But my point is simply this: if the federal government does not put forth as much money as it has been in terms of infrastructure spending, and state and city governments are not in great shape fiscally, one of the things that we might see in the 2030s is less spending on infrastructure, something to watch for going forward. Now, Rocky 5, again, that aforementioned or promised leading indicator. This is the Architecture Billings Index. It's a reflection of how busy architects are. And this is a leading indicator, actually, as it turns out, for the wall and ceiling industry, because the notion is if architects are less busy upstream, contractors will be less busy downstream, at least contractors who work on projects involving architects, which of course many of you do. So you see the 50-yard line running west and east across that slide. Any reading less than 50 signifies that architects are less busy this month than they were last month. Now, the last reading at 49.8, March of 2026, is not horrific, but it's less than 50, which means that in March, architects were less busy than they were in February less busy than in January, December, November. You get the point. This has been happening now for around 2 years. And that precedes some of the weakness we see in certain segments of construction. So Rocky 6, as defined by the U.S. Census Bureau, there are 16 categories of non-residential construction in our country, all are listed here. Those are the green bars. Now, this shows construction spending in non-residential categories between March of 2025 and March of 2026, the last year for which we have data. Now, we've had a lot of inflation in the economy. If we can agree that construction delivery costs are up about 5 to 6% over the past year, around that, any reading here below 5 or 6% tells you that actual amount of construction services delivered has fallen. Overall, non-residential construction spending is only up 0.2%. So if you're just for inflation, that's negative. Where do you see some of the growth here? Some of the publicly financed categories: sewage and waste disposal, which is about 95% publicly financed. Growth, conservation development, that's your flood control. Growth. But where do you see the losses here? At the very bottom, including manufacturing. And we could blame that on tariffs or the, basically the winding down of the Chips and Science Act, also signed by President Biden in August of 2022, whatever, but it's down a lot. And that heretofore has been a fifth of all non-residential construction. So when that segment takes a hit, it drags down the figures for the overall construction industry. Commercial, that's your warehouses, your retail space, not very strong. Healthcare, of course, has been a source of significant construction spending growth, but many of these major medical systems now have run out of stimulus funds. They're having a tough time just affording their nursing staff at this point. And so that leaves less money for capital expenditures. So that's where we are right now. And basically what I would liken it to is a dam. And behind that dam is a bunch of would-be potential construction projects. But that dam is comprised of very high interest rates, high materials prices, rising labor costs, and so those projects can't move forward because they're not financially feasible right now. When will that dam begin to collapse? When interest rates start to fall. And that's what we're waiting for. Now, again, to discuss why many of these projects are not penciling out, here's Canadian non-residential construction spending. February of 2025 to February of 2026, these data come from Statistics Canada, or Statistique Canada. But the point is, the overall numbers have been better here, 3.4%, but you can see a lot of government influence in the growth. So laboratories, so a lot of the biological research capacity in Canada was constructed, the built environment was constructed in the 1970s. So there's been a major effort by the Canadian governments, the folks in Ottawa, to try to stimulate biological research and development by refurbishing laboratories. And so there's been a lot of money, billions of Canadian dollars, as it turns out, on this effort. Welfare home, it's exactly what it sounds like. The spending on housing units by the public sector. So the public sector is really driving a lot of this growth. Where do you see the loss in activity? Factories, the same thing that you see in the United States. Government and institutional spending, schools and education, right? So a lot of similarities, even though the segment names, the construction segment names are different across the two countries, two different histories, so on and so forth, two different societies, it is still the case that you see some correlating or corresponding trends between the two. Now, again, why do some of these projects not pencil? Well, right here, this is the producer price index, and this is the producer price index for construction materials. We're starting with February of 2020 as a baseline. Why that month? That's the last month before the US economy was shut down. So these are US data. So the public health emergency that shuts down much of the economy is declared on March 13th of 2020. So if you look at construction materials prices back in February of 2020 and compare those to April of 2026 prices, materials prices in about 6 years and 2 months, have risen 51.3%. Do the math on this. That means that on average, for every month, for more than 6 years, construction materials prices have risen 2/3 of a percentage point. Now, it's not been consistent. There was a massive increase in materials prices during the pandemic, of course, supply chain issues, for instance. And there's been a more recent surge in construction materials prices due to tariffs. And now, as it turns out, conflict in the Middle East. So you look at these, you say, where do we see the most inflation in construction materials? Energy, crude energy materials, natural gas, crude petroleum. But after that comes a series of products that are very much tariff influenced, steel mill product prices, non-ferrous wire and cable, that's your copper wire and cable, copper subject to a 50% tariff, and a lot of copper is used in data centers. Fabricated structural metal products, iron and steel. That's where you see the most inflation. No surprise. This is the producer price index for gypsum. Just to give you some sense of this. The actual price based on government data, and your experience may be different, is down 1% year over year, but these prices up 48.4% since February of 2020. So once prices go up, they don't come down, generally speaking. You get some globally traded commodities like an oil, which is really an investment product as much as a material. That can jump up and down as it turns out. But things like gypsum, which people don't really trade in as much, this is a reflection of supply and demand for gypsum and for industry purposes. Once prices rise, they tend not to fall. And then you say, Anirban, what about those of us who aren't, so much into drywall? Well, here's insulation materials. So this is the producer price index. It's the index reading, by the way. The previous slide was index. This is the index reading as opposed to an actual price. But the index is telling you how much prices have increased, how they've changed. And in this instance, again, insulation materials prices up 0.1% year over year, but up 48% since February of 2020. That's summarized in the caption box in the southeast corner of the slide. And again, it's what makes a lot of these projects not viable, not feasible financially. And when we get the May, June, July data, you might see another surge in these prices as the conflict in the Middle East has its second and third order effects. So let's talk about the forecast. The forecast is a real cliffhanger, the final part of my presentation. This is 1993 Stallone film, and it was an amazing film. And it was a top 10 grossing film of that year. And that's really saying something because that was an amazing year for American film. For that year, The Fugitive comes out, starring Harrison Ford and Tommy Lee Jones. The Firm comes out, starring among others Tom Cruise and Gene Hackman. Schindler's List comes out, starring Liam Neeson. Indecent Proposal comes out, starring Robert Redford. Mrs. Doubtfire comes out, starring Robin Williams. Sleepless in Seattle comes out, starring Meg Ryan and Tom Hanks. The number one grossing film of that year, of course, was Jurassic Park, starring a group of dinosaurs and Jeff Goldblum. And this, with all those movies, this is this is the number 10 grossing film of the year. And people loved the opening sequence. They loved, Stallone's action in that. I think they also relate to the storyline, because the movie is about, and they can really relate to the plot, because the movie is about a group of European gangsters wielding machine guns shooting at rock climbers in the Rocky Mountains. And many Americans respond to that by saying, you know what? We can never let that happen in our country. And guess what? Because of our vigilance, it never has. And so again, send up some alarm bells for some people. Anyway, the point is, a great film. Now, I don't too much data here, right? It's a big world, lots of countries, but these are forecasts for GDP growth for various parts of the world for 2026. I just point you to the top half of the slide. United States forecast from the International Monetary Fund 2.3% growth this year, and Canada, despite facing U.S. tariffs and other headwinds, 1.5%, not bad. By advanced world standards, the Americans and the Canadians will be among the top performers. Take a deeper dive into the largest economy in the world, forecasts for U.S. GDP growth. So I got 7 forecasts here. The most important is the second from the left, the FOMC. That's your Federal Reserve, the Federal Open Market Committee. But if you take an average of these 7 forecasts, you'd come up with around 2.1%. Not a hint of recession. And yet you've got all this pessimism. And yet, despite the sanguinity of these baseline forecasts, the fact that they're relatively upbeat, you have a lot of pessimism out there, and you've got lots to talk about recession. In a typical year, the risk of recession is between 10 and 15%. But we're in the year 2026. We've had 3 recessions in the US thus far this century. And it takes something really major to buckle the amazingly resilient US economy. You need something like the dot-com bubble bursting in 2000, followed by the mild 2001 recession. Or you need the housing bubble bursting in 05, 06, 07, followed by the not-so-mild 07 through 09 recession, or you need COVID. But something really dramatic to bring the US economy to her knees. And yet, 10 to 50% chance in any given year. But right now, if you ask various prognosticators, what's the risk of recession next 12 months? Well, Wells Fargo says 20%, Moody's says 45%. Take an average of these 6 bars, you'll get a bit north of 30%. Why 2 or 3 times the norm in terms of recession probability? Here's why. It's because the foundation of U.S. economic growth has narrowed so dramatically in the last couple of years. A couple of years ago, America is adding a ton of jobs. And we saw lots of wage growth, including among entry-level workers, restaurant workers, hotel workers, so on and so forth, entry-level construction workers. Not idealized that economy. Inflation was higher back there. Stock prices were lower back then, but we're adding a lot of jobs. And basically all 5 quintiles of America were participating in that economic expansion. Now ask yourself what's driving the US economy forward. Artificial intelligence, corporate earnings, stock market, spending by wealthy people. All of those things are intertwined. All you would need is an announcement or 2 by some hyperscale saying, we're pulling back on expenditures. We're spending too much money. We're not getting the return on investment that we need to satisfy our shareholders. Corporate earnings forecast dim. Stock market doesn't do as well. Rich people get nervous. Now, on top of that, I will say you've got the One Big Beautiful Bill in the United States, which will have its maximum stimulus as a tax bill this year. You've got a lot of federal deficit spending in the United States. That props up demand. And you've got something called deregulation. Not of all industries, not offshore wind, for instance, that the Trump administration has pushed back on aggressively. But you do have deregulation in financial services, fossil fuel production and distribution, so on and so on. And so all things equal, that's probably a positive economic growth. So what's my outlook? Let me summarize it for you with this final slide, because the alarm is on. I'm running out of time. I do want to leave at least 5 minutes for Q&A. But I spelled alarm wrong here, apparently. I spelled A-L-A-R-U-M. Why? Because Alarm is a 2025 Stallone film. It's maybe not one you've heard of or seen because it's a terrible film. It also stars Scott Eastwood, who is one of Clint Eastwood's 2 sons. He also has, by the way, Clint Eastwood's 6 daughters born by 6 different women. I find that impressive, though I should not. I understand that could be offensive to some people. But by the way, the youngest of those daughters born in 1996, the oldest in 1954. Impressive. Anyway, I'm getting a far field. Let me summarize here. Inflation poised stage of comeback. You see it in the data. You see it in your lives. Whether you want to attribute that to tariffs or immigration shifts or war, and that means interest rates higher for longer. That dam is still standing, blockading a lot of projects that would move forward. We need more housing, and at some point, you're going to see a surge in residential construction. It's going to be a boom. because the millennials and Generation Z need more housing. And eventually the private markets are going to deliver, but you need lower mortgage rates and project financing costs for that to happen. We're not there yet. For the time being, many consumers are not exhausted financially, and their circumstances worsen. So again, hey, if you have a nice stock portfolio, you're happy. Dow Jones is trading, neatly above 50,000 at this moment, or at least a few points above 50,000. If you don't, and you just try to pay for food and rent and so on and so forth and gasoline, so that part of the economy, that maybe the lower two quintiles, something like this, they're going to tell you they're in their own personal recession. Are asset prices overextended? Is the Dow worth 50,000? Is the S&P worth 7,500? Is Bitcoin worth 81 or 82,000? Is gold worth 47.50 an ounce? I don't know, but there are lots of gains built to those prices, and what goes up can come down. And there's a fair amount of complacency among investors right now, bidding up various asset prices, which is great for the economy in the short term. But if those prices start to reverse, then of course that could be a problem. So look, I think there's enough to drive the U.S. economy forward and the Canadian economy in 2026. Growth is my forecast, but the risks, rising interest rates, which you might see, you've already been seeing recently, it's exactly the opposite of what you wanted. If somebody had said to you in mid-February, hey, do you think it's more likely that interest rates are going to go up by half a percentage point or down by half a percentage point? You probably would have said they're going to go down by half a percentage point. They can't go up. They've gone up. If you look at long-term rates, they've gone up by half a percentage point or more. And then, of course, falling asset prices, because as I say, what goes up can come down. If you like this kind of data analysis, I have a newsletter at www.sagecon.com. There's a free service here, so I'm not necessarily for dollars. If you're not interested in the newsletter, please, anytime, go ahead, feel free, and pound sand. And with that, hey, thanks a lot for the opportunity. It's been a privilege. I have left a handful of minutes for Q&A, so let us please turn to that part of the festivities. Thank you very much.
And thank you, Dr. Basu. We do have a few questions here. One of our listeners is asking, which supply chain challenges still concern you the most?
Well, I mean, that one's, I think, fairly easy. It's the Strait of Hormuz, of course, which stands between the Persian Gulf and the Gulf of Oman. The Gulf of Oman, of course, leads to the Arabian Sea into the Indian Ocean. But that's the number one supply chain issue. But you've got a lot of other issues in electronic components. So if you look at the producer price index for electronic components and semiconductors, that's up 28% in price over the past year. And so, one of the issues here for these hyperscalers is they're spending a ton on these data centers, a lot on computer chips that go into these servers, that go into these data centers, and of course on core and shell. They're spending a lot on land and trying to, pay for electricity. So, I mean, it's a lot. And my concern is that when you have such expensive computer chips, for instance, and such expensive electricity and diesel fuel, that some of these projects are not going to move forward. And that will weaken the overall construction segment. So data centers are really critical right now because a lot of construction segments are not working that well in terms of generating new opportunities for contractors. I'm a little bit worried because the costs are so high. And by the way, Google/Alphabet is actually raising debt by selling bonds abroad now. So they're selling bonds denominated in yen and other currencies to try to get enough money to put into these data centers. So they're taking on debt. And so these dynamics make me nervous.
And one final question. If you could give commercial construction leaders one piece of advice for the remainder of this year and the beginning of next year, what would that be?
I would say, please understand that another surge in construction demand is coming. If you do not work in the data center space, for instance, and many smaller contractors don't, by the way, because they can't get the bonding necessary to participate in that kind of project. There's such high stakes, there's so much valuable equipment, et cetera. Then those segments that have not been working so well for you lately in terms of supplying or supporting backlog, they're going to come back. But the key, of course, is lower interest rates. I think once this conflict in the Middle East or war in the Middle East is over, you're going to see pretty rapid declines in oil and other prices. You're going to see some deflationary pressures. And that means if this war ends quickly, in 2027, you can get the interest rate relief that you want, and therefore more projects move forward. So don't get rid of your capacity to deliver construction services too quickly, would be my advice. If you want to let go of some people at the edges, you're not star performers. You're less reliable performers. That's one thing to preserve cash flow. But your star is going to be busy later this decade. If they're not that busy right now, they will be, because the next wave of construction starts is coming.
Well, thank you. That is all for our questions. And on behalf of AWCI, I would like to thank Dr. Basu and all of our attendees for joining us, and the Foundation of the Wall and Ceiling Industry for sponsoring this webinar. Stay well, and we'll see you next time in the future. Thank you all.